Two dates, one crack. In August 1989 and again in 2001, the curve flipped, auctions softened, and a downturn followed. In 2025, the same pairing returns, calm headlines, tense funding. The Treasury's refundings are larger, primary dealers are carrying more duration, and real yields won't blink just because the Fed pauses. That contradiction tight spreads alongside rising interest costs doesn't last. When the auction window whispers, pay more or clear less, resets don't wait for a press conference. They happen at the close, but the contradiction cuts deeper. Credit spreads the gap between risky and safe. Borrowing stayed tight as fiscal deficits grew. That pairing doesn't endure without a reset. In 1999, spreads were quiet before the break. In 2007, they were late to move as leverage piled up, so the mechanism matters. Debt issued at low coupons. The fixed interest rates on bonds must roll at higher coupons. Interest costs compound. Cash flows thin. The cycle slows. The math doesn't care who's in office. The pattern showed up early. Primary dealers, the banks required to bid at Treasury auctions, warehoused more duration while households retrenched. That isn't euphoric risk-taking. It's obligation. What changes when the buyers demand a different price? The mechanism works like this. Issue at 2% in a low-rate year. Refinance at 4%. When term premium, the extra yield investors' demand for holding long bonds rises. Every trillion refinanced doubles the annual burden relative to the old rate. The result? Less room for everything else. Look at what happened before. In 1989, the curve normalized as growth cooled. Recession followed. In 2001, tech valuations cracked while the labor market still looked okay. The break didn't start where people stared. That's the setup. Why would this time be different? So far, market prices suggest calm while the plumbing signals strain. Coming up, the forces that push a reset. Now the pressure builds across four pipes: interest cost, rollover, bank balance sheets, and global reserve flows. Rollover refinancing old debt with new debt arrives on a maturity wall when lots of debt comes due at once. That wall compresses choice. The system must pay up or shrink. Watch the timing. When auction tail, when demand is weak at a Treasury auction, shows up repeatedly. The marginal buyer sets tougher terms. Real yields, the interest rate minus inflation rise, even if inflation falls. That's a confidence negotiation, not a price spike. Markets price time, not headlines. Follow the money. Find the pressure. Sovereign wealth funds. Government investment pools rotate between cash, bills, and long bonds. Central banks juggle foreign exchange reserves dollars and other currencies held by central banks against domestic growth needs. If they stop adding duration, the private sector must step in. The private sector always demands a higher return. The numbers prove the constraint. Interest costs climbed by hundreds of billions within a few years. Issuance stayed high as deficits persisted. Banks faced tighter capital rules. Households saved less as housing stayed dear relative to incomes. None of those are moods. They're arithmetic. Check this contradiction. Asset prices rallied while real personal income growth lagged trend. That gap can close two ways. Incomes catch up, or prices reset. Last cycle, the close came with a snap. The one before that came with a grind. Which path appears when funding costs refuse to fall? So far, rollover math tightens while buyers ask for more yield. Coming up, the mechanism inside auctions, balance sheets, and spreads. The mechanism works like this. Treasury sells more notes. Primary dealers absorb what others won't. Balance sheets fill. Dealers hedge with futures and swaps. Spreads the gaps between related interest rates, move as balance sheet costs rise. If end investors bulk, tails widen. If tails widen, coupons go up. The cycle feeds on itself. Notice the gap. Policymakers prefer gradualism. Markets prefer clearance. Clearance means prices that clear supply today, not stories about tomorrow. When those preferences collide at the auction window, price speaks loudest. The signal appeared in history. On August 15, 1971, convertibility broke and a reset followed through prices and wages. On October 19, 1987, valuation met liquidity and the air pocket formed. On September 15, 2008, collateral quality met leverage and the system repriced risk in days. Different triggers. Same math. Follow the money, find the pressure. If the official sector must stabilize long maturities, it trades future flexibility for present calm. If it refuses, the market sets rates higher until demand returns. Either way, the bill lands somewhere. The constraint is simple. A government can tax, borrow, or inflate. It can sell assets. It can cut spending. It cannot repeal compound interest. When coupons reset higher, the future becomes smaller unless growth outruns the bill. Watch what happens next. Banks hold more safe assets under rules. Funds roll from bills to notes when curves steepen. Corporates pull forward issuance before spreads widen. Households stretch less as mortgages reset. Each actor is rational alone. Together they push toward a single price, the clearing rate for time. So far, auctions clear, but at prices that climb. Coming up, who moves first when the strain shows? Now the players take the stage. The Federal Reserve sets monetary policy, how it manages interest rates and the money supply. It can cut or hold, and it can run its balance sheet down. Balance sheet runoff is when it lets bonds mature without replacing them or slow that runoff. It cannot fix fiscal arithmetic. The US Treasury finances the gap. It can shift the mix toward bills to ease duration. It can extend tenor to lock in rates. It can scale quarterly refundings, the big lump auctions up or down. It cannot shrink required issuance without policy choices outside its mandate. The European Central Bank handles a different map. Fragmented bond markets, member states with different risks. When term premium rises in the US, Europe feels the pull through currency and capital flows. The Bank of Japan faces another bind. Yield curve control pinning long yields meets imported inflation. That is a hard corner to stand in forever. The mechanism is global. Dollars fund trade and credit. When real yields rise, dollars tighten the world. Emerging markets with dollar debt face rollover at worst terms. Capital comes home. Domestic credit slows. It's not personal. It's plumbing. The pattern emerged before. In 1997, Asia's pegs cracked when dollars got scarce. In 2011, Europe's periphery met funding stress as growth sagged. In 2020, liquidity guarantees stopped a spiral. Tools change. Incentives don't. The tell, dealers can carry only so much duration before hedging costs dominate. If foreign official buyers reduce their share, private balance sheets must expand or prices must fall. If banks face higher capital charges, the marginal buyer will be a fund that demands spread. So far, institutions act within mandates. Coming up, the reset paths and what decides which one shows. Now the possible resets split three ways. First path, prices fall fast. That is the air pocket path. Valuation meets higher real yields. Multiples compress. Funding costs rise. Weak hands sell to strong hands. The system clears quickly. It hurts, then it heals. Second path, prices grind while incomes rise. That is the catch-up path. Wages grow, profits compress. Policy steadies at higher real yields. The market digests supply at measured coupons. It hurts, but the wound is shallow. Third path, financial repression. That is the silent path. Policy holds nominal rates below inflation for years. Real yields stay negative. Savers carry the load. Debt ratios fall without a default. It hurts quietly, and it lasts. The numbers guide which path we take. If real yields rise above 2% and stay there, and valuation carries more of the load. If issuance shifts toward bills, near-term pressure eases, but rollover risk returns sooner. If deficits narrow, pressure eases more broadly. If not, the maturity wall grows taller. Check the timing on this. When corporate spreads stay tight while profits slide, stress shifts to equity first. When spreads widen before profits slide, credit leads the break. That ordering matters. It tells where the first buyer steps back. The pattern showed up early. Housing stayed expensive versus incomes. Savings rates fell. Labour supply improved, but productivity gains wobbled. Those aren't crash signals by themselves. They are the dry timber that a spark can find. So far, 3 reset paths exist, and incentives decide. Coming up, the 3 warning signs that choose the path. Stay for 3 warning signs that decide soft landing versus hard stop. They'll appear in the same places each time: funding, labour, and auctions. Warning sign 1 in 60 seconds. Watch real yields versus profits. Now the countdown matters. Every market lives by dates. Quarterly refundings cluster supply. Inflation prints set real yields. Policy meetings set the path for the front end. 3 dates decide the next move. A late January refunding announcement for sizing, a mid-February inflation print for real yields, and a mid-March policy meeting for the rate path. The exact days differ by calendar. The function is the same. The mechanism emerges around those beats. If refunding tilts longer while foreign buyers step back, tails widen. If inflation proves sticky, real yields rise even on a hold. If policy guidance softens while growth stays okay, curves can steepen without panic. The sequence matters. Notice the contradiction. A stronger dollar alongside rising gold can appear together. That isn't currency collapse. It's global investors seeking hedges while they still trust bills. When trust slips, bills richen further before anything else. That's when things shift. If the refunding leans long and tails widen, the snap you saw this month won't be the last. If the inflation print cools fast, the market can test a gentler path. If the meeting signals patience while growth weakens, the grind path lengthens. Which lever moves first? So far, calendar beats set the near-term map. Coming up, the institutional behaviours that lock in the destination. Follow the money, find the pressure, watch bank lending standards. Tighter standards precedes slower hiring. Watch state and local budgets. Deficits there force choices on projects and payrolls. Watch global reserve moves, and selling long bonds to defend currencies pulls duration demand away at the worst time. The math shows the scale. Interest expense now rivals big line budgets in size. When that line grows faster than revenues, something else shrinks. Investments get delayed. Programs get trimmed. The private sector pays a higher rate. The cycle cools. The constraint is durable. A system can stretch time by rolling bills. It cannot escape the bill. Extend duration and pay more now. Shorten duration and pay more later. Markets choose for the issuer if the issuer won't choose. The result? A reset that matches the tightest constraint. If growth can outrun interest, the catch-up path wins. If not, prices must do more work. If policy suppresses nominal rates, the burden shifts to savers over years. So far, the destination follows arithmetic, not slogans. Coming up, the payoff 3 clear warning signs and a simple scorecard. Watch what happens next. The motif repeats: follow the money, find the pressure. Small cracks, big breaks is a myth. Systems rarely shatter out of nowhere. Signals stack. Then the outcome looks sudden. 3 warning signs, your dashboard for the reset decision. 1. Profits versus real yields. If real yields rise while profits fall for 2 quarters, valuation bears the load. That points to the fast reset. 2. Refunding mix and tails. If longer dated supply rises and auction tails appear often, coupons must rise to clear. That points to the grind or the snap, depending on buyers. 3. Bank standards and hiring. If banks tighten as job openings drop, spending slows next. That points to catch-up failing and repression or reset doing the work. Now pressure meets time. The calendar carries the near-term pulse. Late January refunding. Mid-February inflation. Mid-March policy 3 dates. 1 story. Look at this closing scorecard facts only. Auctions, firm or soft. Longer supply with small tails means clearance. Big tails mean price must adjust. Real yields, rising or falling. Rising real yields mean investors demand more pay for time. Central bank flows, adding or pausing. Adding means official support. Pausing means private balance sheets must step in. That's the map for a once-in-a-lifetime economic reset. The incentives are clear. The arithmetic is simple. The timing will be decided where money meets time.